Okay, so how can we determine the value we are getting out of a company? So far we are able to determine a cheap company from an expensive company. We have also put in measures in place to ensure the company does not go bankrupt as it may be unable to pay its debt. Let's look at the growth potential, what we can get out of a company. Like the discussion we had earlier, where you have house A going for $100,000 and house B going for $150,000, but house A was older than house B, the price can be justified, and the same happens for companies you want to invest in. Now that you understand how to calculate the value of companies, what if you had company A, which had a price to earnings ratio of 10, whereas company B had a price to earnings ratio of 20? It is quite obvious that company A is cheaper than company B, but what if this was justified? What if company B was providing more value, more of a return to its shareholders, the same way house B was more modern than house A? A company provides value to shareholders in three forms: dividends, share repurchases, and an increase in profit. In a perfect world, if you had two companies which both had the same price to earnings ratio, you would expect them to both provide the same amount of value to the shareholders in the form of dividends, share repurchases, and earnings growth. So let's dive a little deeper into these three forms of shareholder return: dividends, share repurchases, and increase in earnings. What are dividends? Dividends are payments made to the shareholder by the company as a reward for being a shareholder of the company. Now, not all companies pay dividends. As a general rule, you find those companies that are relatively stable, such as Coca-Cola or Johnson & Johnson. For those of you who don't know, these companies sell goods that we need to use every single day. Naturally, they have very stable, slow-growing businesses and are the ones that pay consistent dividends. They can afford to pay these dividends because they are large companies in a mature stage of their business life cycle in relatively stable industries. They are able to generate a tremendous amount of steady profits, which enables the management to declare a dividend to be paid to the shareholder. Growing companies, on the other hand, like Amazon and Tesla, do not pay a dividend because they are fast growing companies and would rather reinvest that cash into the business in order to generate more value for the shareholder in the future. Is a company that pays a dividend better than a company that does not? Not necessarily, because a company which does not pay out a dividend to its shareholders may be able to reinvest that cash in the business, and the shareholder may therefore obtain a higher return on that money in the form of increased earnings in the future. When it comes to dividends, you as a value investor care about the dividend per share. In order to calculate it, you need the dividend paid divided by the number of outstanding shares. The dividends per share can be found from a simple Control plus F at the same time on your keyboard and type in the word dividend. Press enter until you arrive at the dividend per share figure. If not, you could go to item 8 in the index page, which tells you where the financial statements are, as you already know. When you arrive at your financial statement, look for the financial statement called Statement of Changes in Equity, or a stockholder's equity statement. At the bottom of that statement, you will find the dividend per share. You already know where to find the number of outstanding shares in the income statement. The full amount of the dividend paid will be disclosed in the notes to the financial statement. The exact note may differ from company to company. In order to find this amount, however, once again, just press Ctrl plus F on your keyboard until you come to a table which talks about the dividends declared and the amount. I will show you an example in a bit. Share repurchases, on the other hand, are when the company you have invested in buys back its own shares. This provides value to you if the price the company purchases the shares from you at is greater than the price you initially purchased the shares for. Therefore, the company will submit an offer to the shareholder to buy back the share it issued at a certain price. You as a shareholder will then have a decision to make as to whether you want to sell your shares back to the company at the price offered. Why do companies buy back shares? There are many reasons, but some of the most common reasons are management of the company may have invested in the management of the company you have invested in may also believe that the company is undervalued, and hence may feel that a purchase of its own shares will also be a wise investment. In addition, it is another way for the company to distribute cash back to the shareholder. The problem with share repurchases is that many of them are unpredictable. Now, the tricky one is the increase in the share price. As an investor, it would be preferable to invest in a company that will increase its share price by 20% versus 5%, all else equal. What determines the increase in the share price? Quite simply, it is whether the bottom line, the net income, is increasing. If the company is growing its profit, its earnings, its net income every year, the share price will grow every year. If you are looking to buy a private business, I think we can both agree that a company which is able to grow its earnings faster than another company, assuming they both go for the same price and they both produce the same earnings currently, the faster growing company is the better investment. Why do you want to invest in a company that is able to increase its earnings over time? Simply because in the long run, the share price will follow the earnings. If, for example, over a 10-year period, earnings tripled, the price of the share will also triple. The business is now generating triple the amount of earnings it was generating 10 years ago, and logically, the business will be worth 3 times what it was worth 10 years ago. This increase in the share price is what we call capital appreciation. Tesla and Nvidia are examples of companies growing their earnings rather rapidly relative to other entities. This usually happens when a company has a competitive advantage over the other companies in the market. Now, with regards to the dividend, here I just wanted to show you what the amount, that the amounts can be easily found in the statement of changes in equity. As you can see there, right at the bottom, it says there, cash dividends declared per share for 2019 of $1.84. If you want to calculate it, once you have found the amount paid in the annual report, there in the orange circle, I've highlighted it, it's $14 billion or so. Remember, I found this by doing pressing Control and F on my keyboard. What you want to do is you want to take this amount here of $14 billion or so, and you want to divide it by the number of shares issued, which we got from the bottom of the income statement in the previous example. So as you can see there, the calculation, it's going to be the 14 billion or so dollars in dividends paid divided by the 7.6 billion or so shares issued. So, how do we combine all these 3 factors in order to determine the value that is being returned to shareholders? When it comes to the dividend, we want to look at the dividend yield ratio. This is calculated by taking the dividend paid per share and dividing it by the current share price. You know how to find the dividend paid per share, and you know how to find the price per share. Therefore, a dividend yield of 3% means for every $1 that I spend on a share, I will get 3 cents in dividends. I want you to keep in mind the 3% because this is the return you are getting on the price you are paying. Then when it comes to share repurchases, these are rather unpredictable. And as an investor, these are not some things you would normally consider when valuing a company. How can we determine the increase in earnings? This part involves some work on the investor's behalf. As no one can predict the future, the best bet one has at evaluating the future increase in earnings is a look at the past average. Peter Lynch, a famed growth at a reasonable price investor, achieved an average return of 29.2% per year for his clients over a 13-year period. He achieved this by looking at cheap companies with high growth potential. One of the tools he used in order to determine this growth was to look at the average earnings per share growth for the last 5 years. Yes, it does involve a little bit of work, but it has to be done. When determining the estimated increase in earnings, we cannot see into the future, but we can use the past to guide our decision. A company with a high average earnings growth rate for the last 5 years of say 20% may continue into the future. However, only after an objective appraisal of the business and its competitive advantages, because companies that grow fast do attract competition, can we ensure that this 20% growth is reasonable. When it comes to the increase in earnings, however, we quite simply want to get a rough figure of the increase in earnings we can expect, and therefore using the 5-year average is a good starting point. Remember, you need to calculate the average increase in earnings for the last 5 years. That means you need to calculate the increase in net income for each of the last 5 years, add those 5 figures together and divide it by 5. The increase is simply the net income for the year divided by the net income for the previous year minus 1. That gives you the percentage increase in net income for 1 year. You need to do that for each of the last 5 years. Example, I want the average increase in net income for the last 5 years. I'm currently valuing a company now in 2020. That means I need to calculate the increase in net income from 2019 to 2020, the increase from 2018 to 2019, the increase from 2017 to 2018, the increase from 2016 to 2017, and the increase from 2015 to 2016. Add all those figures together and divide it by 5. This will be covered more detail in the practical example.